One of the key fundamentals I look at when I am researching a stock is the price to earnings ratio. A stock with a low PE ratio in comparison to other stocks in the same sector can often mean that the company is undervalued and can lead to some oversized potential for making money. In today's video, we will be looking at these potential diamonds in the rough, and we will begin right now. A value stock, in a nutshell, is a stock that is listed at a price lower than its fair market value. This can be an indication that the stock is ripe for some good growth over the long term. Generally speaking, value stocks are not always the best bet for short-term gains. The 7 stocks I have found for today's video are good values for long-term investing, though some of them have some passive income and better short-term potential than most value stocks tend to have. One of the key fundamentals I used in helping me to locate these stocks is the price to earnings ratio, or PE ratio. This is the ratio of a company's share price to their earnings per share. This is a ratio that can be used to determine if a company is undervalued or overvalued. It shows us what investors are willing to pay today for a stock. A high PE ratio can mean that the stock is overvalued, while a low PE ratio can mean that it is undervalued. Of course, there are exceptions to both rules, so you always want to make sure you do your full fundamentals. PE ratio can also be valuable in comparing stocks within the same sector or even against a benchmark such as the S&P 500, which typically has an average PE ratio ranging from 13 to 15. For today's list, we are looking at 7 companies with lower PE ratios and with fundamentals that suggest there could be some room for long-term growth. So without any further ado, let's jump in. Our first company of the day is Stelco Holdings Inc., who have a ticker of STLC. They are a Canadian steel company based out of Hamilton. They have had a rough past, which includes a bankruptcy in 2007. That, of course, resulted in the company being bought by an American company called Bedrock Industries. No, the CEO is not Fred Flintstone. Nowadays, they produce steel products for the automotive, energy, construction, as well as the pipe and tube industries. They have a market cap of $2.9 billion. Their shares sell for $40.29 at the time of recording, and their earnings per share, or EPS, is 21.47. Their PE ratio is a very respectable 1.90. Now, in North America, the average PE ratio in the steel industries is roughly 27.55. So that's not too bad. They do have a yield of 2.978%, which is paid out quarterly in the amount of 30 cents per share. In terms of growth, they had a return on investment in the last year of 23.7% for a total return of 26.7%. With this one, they are doing well in the present, and with a potential to grow in the future, I would have to say that this is a company worth watching. Up next, we have Power Corporation of Canada with a ticket of POW. They are a diversified holding company based out of Montreal with many holdings in the financial sector, including a major stake in Wealthsimple. They have a market cap of $22.6 billion. Their shares sell for $36.73 at the time of this recording, and their EPS is 4.20. Their PE ratio is 8.70, which is not too bad. In North America, the average PE ratio in the non-banking financial sector is 42.92. They do have a yield of 5.391%, which is paid out quarterly in the amount of 49.5 cents per share. In terms of growth, they had a return on investment in the last year of negative 7.6% for a total return of negative 2.2%. Yes, this one looks risky. I still see them as a pretty safe bet. For one, their market price is currently down 16.5% in this current market downtrend, which does throw off their growth. For two, their smart investment choices like Wealthsimple paints for me a picture of a company making the right moves. Full disclosure, I am invested in this company, and I will more than likely keep adding to that position. Up next, we have Crescent Point Energy Corp with a ticker of CPG. They are an energy company based out of Calgary. They mainly focus on light oil production in both Saskatchewan and Alberta. They have a market cap of $6.3 billion. Their shares sell for $11.19 at the time of this recording, and their EPS is 6.04. Their PE ratio is 1.90, which is absolutely fantastic. In North America, the average PE ratio in the oil gas production sector is 34.66. They do have a yield of 2.324%, which is paid out quarterly in the amount of 6.5 cents per share. In terms of growth, they have had a return on investment in the last year of 116% for a total return of 118.324%. The whole energy sector is booming, and this is one of those stocks that flew under my radar until now. I will be personally adding this one to my portfolio. Not financial advice, but I think I really like this one. Up next, we have Frontera Energy Corporation with a ticker of FEC. They are another energy company based out of Calgary. They mainly focus on heavy oil development and production in South America. They have a market cap of $1.3 billion. Their shares sell for $13.75 at the time of this recording, and their EPS is 9.76. Their PE ratio is 1.40, which is awesome. In North America, the average PE ratio in the oil gas production sector is once again 34.66. They are the only company on today's list that does not pay any dividends. They are 100% a growth play. Now, in terms of that growth, they had a return on investment in the last year of 117% for, of course, a total return of, 117%. They are a very solid growth choice with the potential for some sustained growth. Up next, we have Manulife Financial Corporation with a ticker of MFC. They are an insurance company based out of Toronto. They operate out of Canada, Asia, and the United States. They have a market cap of $44.5 billion. Their shares sell for $23.16, of course, at the time of this recording, and their EPS is 4.68. Their PE ratio is 4.90, which is way beyond solid. In North America, the average PE ratio in the life insurance sector is 21.21. They do have a yield of 5.699%, which is paid out quarterly in the amount of 33 cents per share. In terms of growth, they had a return on investment in the last year of -9% for a total return of -3.3%. Keep in mind, they are down 21% due to the current market downturn, so that is something I do expect to see them recover from. As for overall growth, they have potential, though so far they have not lived up to that potential. On the bright side, they have a nice amount of passive income, and I do expect to see them recover from the downturn that they are currently in, so there's definitely some growth potential there. As for long term, I'm not sure, but I do think they would be a good midterm pick. Up next, we have, and we've seen these guys before, Labrador Iron Ore Royalty Corporation with a ticker of LIF. They are a royalty company based out of Toronto. They are invested in the iron ore market through its royalty commission and minority equity interests. They have a market cap of $2.1 billion. Their shares sell for $33.60 at the time of, this recording, and their EPS is 5.57. Their PE ratio is 6.00, which is fine. In North America, the average PE ratio in the metals and mining sector is 48.19, so they're way beating that. They do have a yield of 5.952%, which is paid out quarterly in the amount of 50 cents per share. In terms of growth, they had a return on investment in the last year of -35.5% for a total return of -19.5%. This total return took into account their floated-in dividend that changes a lot. In this current downturn, they are down 49%, which makes them look like a loss waiting to happen. However, they have a solid industry and they will more than likely bounce back, which could be an opportunity for some very nice midterm gains. Also, when times are better, their dividend can go way up. For our last company, we have West Fraser Timber with a ticker of WFG. They are a forestry company based out of Quesnel, BC, and they produce lumber products from various wood types like plywood all the way down to newsprint and wood chips. They have a market cap of $11.5 billion. Their shares sell for $115.62 at the time of this recording, and their EPS is 37.52. Their PE ratio is 3.10, which is very, very solid. In North America, the average PE ratio in the paper and forest product sector is 19.46. They do have a small yield of 1.101%, which is paid out quarterly in the amount of 25 cents USD per share. In terms of growth, they had a return on investment in the last year of 34.2% for a total return of 35.3%. Lumber may have already seen its moment in the sun, as it was in crazy demand during the pandemic. However, there is still going to be a steady demand, and that is a growing demand, as lumber is needed for some of the government housing building initiatives. This is a stock that will grow, no doubt, and maybe, just maybe, might have a big growth spurt yet to come. As always, don't take my word as gospel on these stocks, as I am only the beginning of your research. Your financial advisor is the end. If you guys loved this video, be excited. There is way more to come. Until then, why not watch one of these videos? And before you jump into that content, just be sure to like and subscribe to support the channel. I'll see you in the next video.